Welcome to Key Points for the month of September. This month, why we expect the Federal Reserve to move interest rates up for the 8th time, why the Italian budget is going to be so important, and why we would like to see some convergence in the bull market for equities. Now, the first point is that the US economy is doing extremely well. Growth for the second quarter has just been reported at 4.2%. Unemployment has fallen to 3.9%, and companies are reporting that it's harder than ever to fill open job positions. And indeed, finally, inflation has moved up to the Fed's target. So all of this implies that an economy is growing above trend, and we think this will embolden the Federal Reserve to move interest rates up at its meeting towards the end of this month. And indeed, we suspect there will be another rate hike in December. Now, that said, these tightenings are going to have an impact on the economy. The economy is already experiencing its longest expansion or second longest expansion on record. And ultimately, we do think there will be some slowdown as we get into 2019. And we suspect there could even be a contraction again in 2020. Now, turning to our second point, in Europe, the data are also suggesting a stabilization at above trend growth. Now, clearly, this is a good thing. However, investor attention will be focused to the Italian budget, which we suspect will come out later this month or early next month. And the issue that the government faces is a balancing act between living up to some of its election pledges and making sure that the fiscal slippage isn't such to spook markets. And that's really important right now because we have seen Italian bond yields, spreads move up. And the key rating agencies are currently reviewing their outlook for Italy. So it is important to see limited fiscal slippage here to support investors and to appease the rating agencies. Now, we suspect there will be some slippage, but actually what we're more concerned about is the eye is off the ball in terms of doing the reforms that Italy still requires. Now, to our last point in terms of the equity market. The US equity market really is in bull market mode. Most of the broad indices are posting new highs, S&P up around 10% year to date. But what's interesting, of course, is that the other global markets, Japan, Europe, and certainly emerging markets, have really failed to keep pace with this. Now, while we suggest that this bull market has got further to run, we would like to see some convergence. We would like to see these other markets also participate more than they have been. Now, of course, one of the reasons the US has been doing so well is the tax cuts and the repatriations that we've been seeing. And this has lifted investor confidence and pushed these indices to new highs. But Europe earnings are also good, as in Japan, and we suspect over time they will play a little bit of catch-up. That noted, September and October are the worst months for equity returns historically, so we need to be vigilant going forward from here. But the bull market should remain intact. Remember, this full document with all our publications is available on www.zurich.com/MSME.